One of the biggest concerns that we've had for a long time is the concentration of risk in U.S. equities and the valuations. And there's a couple of charts that came out recently. This one's from B of A with the Fed's wealth series information that came out not too long ago, but it was as of the end of the first quarter, and really showing the concentration of household wealth that's in U.S. equities, it's a historic high. It's one of the risks in the marketplace right now, especially at these high valuations that we've been talking about for a while. It's something important to be aware of, because there's a lot of risk of overcrowding in U.S. equities at this time. But let's look at the next one, because Ned Davis Research put together this chart that kind of strips out the pension component of that. If you adjust the wealth series for pension assets, which are individual U.S. household equity assets, it gives an even better picture of the more discretionary money that U.S. investors have in the stock market. And it's truly an even higher high concentration of U.S. household wealth in equity assets. Just an important risk to point out here. Let's keep going. Now, it's not just U.S. households that are concentrated in U.S. financial assets, equities in particular, but the allocation of foreign holdings to U.S. financial assets at large. This was from top-down charts, and recently published, showing also record high foreign holdings of U.S. financial assets. Now, we've been talking about the risk of the dollar, and I realize there are a number that the dollar short trade has become somewhat of a popular and perhaps crowded trade. But when you look at foreigners that are allocated to U.S. assets, it doesn't look like we've seen much rotation at all out of U.S. assets, even though the dollar has started to weaken in a significant way. Let's keep going here. And the real crux of this, and we've shown this probably 100 different ways, and I know Tavi's had a chart in the past that looks at this composite of different valuation measures, and it was just another way of looking at it. Chart that was going around Bloomberg from Macro Bond just a few days ago, showing when you look at the combination of trailing PE, forward PE, Shiller CAPE ratios, price to book, price to sales, EV to EBITDA, et cetera, the combination of valuation metrics is on par or higher than 1929 and the tech bubble in 1999. And yes, valuations have been stretched for a long time. But what's the risk when you have high valuations? It's not really a timing indicator, right? Because things are high, but what's the catalyst? What's the timing? Well, it's a measure of the risk. The catalyst can come from any different direction to burst these bubbles, or to cause a change in the macro trend. We had Trump tariffs back in April, and that was one catalyst for a significant correction. And there's a number of other potential catalysts out there. Now we have Iran, and we have the Israeli-Iran war heating up to a major degree. Is the U.S. going to get involved or not? I mean, these are additional risks in the marketplace. We have stagflationary risk. We have U.S. debt risks. We have this concentration risk that I just pointed out, both U.S. and foreigners concentrated into U.S. equities. What's going to burst these bubbles? We don't know, but exactly. But we need to be ready for these things. Let's keep going here. Cash on the sidelines. Now, Tavi has pointed out this chart before. I thought this guy at i3 Invest did a really good chart on this. The cash on the sidelines, just because we have record amount of cash in money markets does not mean we have record cash on the sidelines. You need to compare the money market cash to the valuation of the equity markets. And this is comparing the money market valuation relative to the NASDAQ 100. And you can see, we're at similar levels to the peak in 2021, to the dot-com bubble in terms of cash available. The secular buying opportunities when there's real cash on the sideline, happens at after significant market corrections, like in 2008, like in the tech bust in 2001, et cetera. So be careful when you hear people talking about record cash on the sidelines. Let's go on to the next. Another risk out there, perhaps a catalyst, insiders, corporate. This is the ratio of sellers to buyers in the S&P 500 stocks. The Financial Times put this chart out recently, at a record high. And this, since this data was collected at least, and insiders can be early sometimes, like they were coming into that peak in late 2021. But this is a new record high level of ratio of sellers to buyers that we have, and just another potential signal. Yeah, could be early, but we don't necessarily know. Just something to be aware of. Insiders have more information than you do. Let's go on to the next. Another potential catalyst, we talk about stagflation. We've seen a lot of evidence. We have stagflationary forces. Here's just one on the economic growth side of things. The Bloomberg Economic Surprise Index is what we're looking at here, year to date. You can see how it's a composite of different economic indicators versus forecast. And you can see it's been weakening consistently all year. At the same time, we have these persistent, more stagflationary pressures. Not just from tariffs, from a variety of structural reasons. The record debt to GDP, the record deficits. Yes, tariffs are inflationary, and that's another potential force. But here's another catalyst potentially for the markets, and another risk. Let's keep going. One thing that we've pointed out in different ways in the past is the counter cyclicality of commodity and industrial stocks relative to a lot of to the market at large. And in this case, we're looking at it compared to the tech industry. And how the CapEx cycles are key indicators and drivers of these rotations from one sector to another. We've been in a CapEx boom in the tech sector. We've highlighted before how that's a huge risk, and this chart is just showing that these are counter-cyclical forces, and you're starting to see a new wave of CapEx coming into the commodity sector. This is bullish early in the cycle, and look how it compares to the tech bubble in 2000. We made a lot of comparisons to the tech bubble in 2000 with the bubble in Magnificent Seven and AI-related companies today. What I think is the bubble, it's just my opinion, but these are indicators that help you to understand why these things are potentially bubbles. We've had this record CapEx boom, record amount of money going into the tech sector, and a record at the same time, this record underinvestment in CapEx in the commodity sector now for over a decade. And these are long-term cyclical forces where money tends to go from one extreme to the other, and the opportunity for counter-cyclical growth on the long side in commodity and industrial related stocks today, we think is is very high. The valuations are low. The bubble in the stock market at large, which again I think it's the bubble, is more related to the tech sector, the Mag 7 stocks, these mega cap stocks that have extraordinarily high valuation and have been in a boom. But to get that return on the investment and the growth going forward from this record CapEx investment is going to be a struggle. Anyway, let's go on to the next. So I want to highlight that Crescat Global Macro Fund, which has been around since 2006, has what is referred to as a negative downside capture ratio. What the heck is that? What that means is that on average, our hedge fund, the Crescat Global Macro Hedge Fund, since its inception in 2006, on average in down markets, in months where the market has gone down, and that would be referring to the S&P 500 on the right-hand bar, our fund has actually gone up. So downside capture, normally when you look at it, you'll say, oh, okay, we're hedge funds will look at this, and consultants who analyze hedge funds will look at this and they'll say, well, are you really doing any hedging? When the markets go down, do you go down less than the market? And if you have a downside capture of 80% or 70% or something like that, well, that means the market went down, but you only went down 70% or 80% of that. But if you have a negative downside capture ratio, that means your funds actually went up when the market went down. And on average, since 2006, when we launched this fund, this is what our funds have been able to do. Now, when you compare it to the Global Hedge Fund Index at large, the HFRX Global Hedge Fund Index, when global hedge funds on average have gone down, our fund has also gone up. And that's the bar on the left. So a lot of hedge funds, don't even hedge these days. They're long only funds in disguise. It's important for us to maintain a low correlation to the S&P 500 at large, and to have short positions, to have counter-cyclical long positions like our activist metals portfolio, so that we're not just an index fund in disguise. We're trying to deliver alpha. We're trying to deliver long-term returns that beat the S&P 500 over long time frames. That's our goal. And we want to do it in a way that, when people really need the ability of a hedge fund to protect in these risky markets like we have today, we want to show the world that we have the macro themes and the positioning to actually be able to deliver and capture upside returns, through our ability to short securities, which we do in our global macro and our long short funds, or our ability to make money on the long side, even in a down market, due to our counter-cyclical long positions like our activist metals portfolio. We think that the negative downside capture ratio since inception in our global macro fund is evidence that we have a hedge fund that's a true hedge fund that is really designed to protect investors on the downside when we get into troubled market conditions, highly risky market conditions. We are not an index fund in disguise. Let's go on to the next. So gold is leading all major asset classes year to date in performance in 25. And it's ahead of Bitcoin. It's ahead of emerging markets, the Swiss franc, the yen up, the energy sector, U.S. stocks at large, treasury bonds, short-term treasury securities, oil, the U.S. dollar. So they're not including silver as a major asset class. Let's go on to the next. Look at silver. It's starting to outperform even gold now in the past month or so, and we've talked about that gold to silver ratio being at historic highs, and really being set up for that gold to silver ratio to come down, meaning silver to start outperforming gold. And we've started to see that, finally in the last month, but maybe it's only the beginning. Yeah, silver's pulling back today. I think it's just an opportunity. Um, but let's keep going here. uh, Silver miners to silver ratio. So this is looking at the global X silver miners ETF relative to silver, and you can see that back in 2016 when that was that first impulsive move up in junior mining stocks and exploration focused stocks. Silver stocks went crazy at that time, and silver had just started to make a move at that time too. But the silver miners to silver ratio, if you think silver to gold is depressed, look at the silver miners to silver ratio. It's even more depressed. But we think this is something that's also on the verge of a breakout. And across all of our funds, we have significant exposure to silver mining stocks, both big silver producers in the case of San Cristobal, which is for our existing investors who are in our side pocket. They own San Cristobal, which is like the fourth largest producing silver mine in the world. Also has an exciting new discovery associated with it, big silver, high grade silver discovery. Our fund investors are invested in who are invested with us are invested in the side pocket. If you've been with us since prior to June of last year, when Deloitte, our auditor, forced us to move this asset into the side pocket, we've been reporting on the X side pocket performance of the funds, and new investors coming into our funds do not get San Cristobal, although there is an opportunity to potentially pick up some if you are interested. Please talk to us. But we have a number of silver positions in our portfolio, not just San Cristobal, and it's a substantial exposure across all of our funds. Let's go on to the next. This was going around from In Gold We Trust. And it shows that most of these companies on here are public mining companies, but they include San Cristobal, a private mining company, which we were just talking about. Thought it was pretty interesting because it's as a company, as a mining company, it's the number 10 largest silver producer in the world, and that's ahead of BHP, ahead of Core Mining, ahead of First Majestic, head of Buenaventura. And when you look at the Silver Institute data as a single mine, the Minera San Cristobal mine is the fourth largest producing silver mine in the world. This is what we own at Crescat. And I just thought that was pretty interesting. Let's go on to the next. When we look at our precious metals fund, this is the performance through May. We launched this fund in August of 2020, and this is the X side pocket performance since June when we spun out the San Cristobal asset into the side pocket. But the fund's up 25.3% net since inception. We're almost approaching our 5-year mark here. At the end of July will be 5 years. So this is 4+ years where gold has now been in a bull market. Gold's up 10.7% annualized since we launched the fund based on that Spider GLD that you can see there. Our fund has been substantially outperforming not only gold, but the XAU, which is the Philadelphia Gold and Silver large cap mining index. It's been outperforming the SLV, which is just spot silver basically. It's been outperforming the VanEck Junior Gold Mining Fund, GDXJ. It's been outperforming the large cap VanEck Gold Miners GDX as well. So, do I think we can continue this alpha, this excess performance above the benchmarks? I mean, absolutely, I do. I think we have an incredible portfolio. It's still early in the cycle for our heavy concentration on more of the exploration side of things. That's where the big upside is. We're creating value through discovery And that's what our activist metals portfolio is all about. So I encourage you to go to our website, look at our presentations up there. We have both the global macro fund, the long short fund, funds that go long and short and invest in a variety of different themes. And we also have the precious metals fund, which is an activist metals fund. It's involved in gold, silver, and other base metals too. We're invested across a number of different companies, over 75 different mining companies. We believe the portfolio is deeply undervalued with an extraordinary appreciation potential and catch-up potential here to gold itself and to gold and silver. And I encourage you to go to our website and check it out.